Hello, my name is Lauren Herbst, your SCORE host and topic presenter for today. Most companies need funding when they start up. Today, we will look at the many alternatives that startups have to obtain funding. There are many sources of funds for a business. This webinar will give you a quick overview of various types of funding you might consider. As a startup, you need to think about some issues to decide how to fund your company. Some of these issues are how much cash you need. For a startup, this is often startup costs plus your losses before you reach break-even. In addition, you need to think about what kind of financing you want to pursue: grants, equity, or debt financing. We will talk more about each one. With grants, the big issue is, can you actually find one? Most for-profit companies cannot. With equity, the big issue is control of the company, i.e., the restrictions on what your company can and can't do without investor approval. With debt, the issues are all the loan terms, including the repayment period, interest rate, any prepayment penalties, and covenants, i.e. requirements and restrictions on your company in the loan agreement. We have talked about family and friends being one of the most common options for startup financing. They can help fund you with either equity, debt, or even a tax-free gift if it is under the IRS gift tax rule, $14,000 per person per year in 2013. You need to get documentation done, i.e. in writing, so that the funding is clearly understood by everyone. This includes the IRS should they audit you and claim that a gift was made when in fact it was an equity transaction or a loan. Equity transactions usually require the assistance of a lawyer because they are more complicated. But you can do loan transactions yourself if they are simple, unsecured loans. All you have to do is go on a website like LegalZoom or Rocket Lawyer and get a simple promissory note form for your state. Then go to Bankrate and get an amortization schedule and attach it to the back of the promissory note. The amortization schedule will guide you as to how much interest each year is deductible for the business and taxable to your friend or family lender. You may be able to get free legal consultation from LegalCorp if they operate in your area. The major downside is whether and how the relationship with your friends and family will be affected if you cannot return their equity or repay their loan. It can be a problem for a very long time, and at times, like family events or at holidays, so this needs to be clearly thought through. There is a number of debt sources. We have discussed equity from family and friends, but they can also make you a loan. We will talk more about that. A second option is a bank or credit union loan. Banks have become more restrictive since the financial crisis, but they are still making loans to startups, so don't be afraid to try them. In most cases with a startup, they will ask you to get an SBA guarantee which partially insures the bank against your failure to repay the bank loan. There is a small upfront charge for the guarantee of around 2%, but you will probably be happy to get the money. Microlenders are a third source of startup funding. They are often nonprofit lenders who specialize in lending to certain groups: minorities, women, urban businesses. They often have lending limits that top out at or below $50,000. They also may require you to take a 10-plus week course in entrepreneurship before they will consider your loan application. You can find them by asking a banker or looking on the internet. Some city and county governments have economic development programs that include low-interest loans to businesses that locate within their borders. Information on these loans can be found on their websites or talking to bankers in those communities. Commercial real estate loans are usually made by specialty lenders. The SBA has a specific program, the CDC 504 loan program, that supports them. You can find these lenders by looking on the SBA.gov website, talking to a banker, or searching the internet. Equipment financing can be done in two ways, either by getting a loan or a lease. Loans or leases for equipment can be done through a bank or equipment leasing company. The major advantage of leasing is 100% financing or close to that, and interest rates that are comparable to a loan. The major disadvantage is that there is no prepayment allowed with most leases. You must be prepared to make all of the payments on the lease until it ends. Leasing companies are easy to find on the internet. Type equipment leasing into Google along with your city and state. If you are buying a business, you may well need seller financing. It is normal and customary for the seller of a business to finance the buyer. Terms vary, but expect to put down 33% of the sale price as a down payment, a 5 to 7 year loan term, and an interest rate in the 6 to 8% range. Your broker or lawyer can help you negotiate the deal. If you need to finance leasehold improvements, the best place may be the landlord. It is very common for landlords to do this kind of financing for creditworthy lessees. Terms can vary widely. You should have a lawyer help in reviewing the lease. At the same time, they can then help you negotiate the terms of the leasehold improvement financing. Home equity financing was popular before the financial crisis when home prices were higher and were increasing rapidly. But this option is still available from banks and other home equity financing sources. So if your home has equity in it, you may want to consider this option. Rates are low and comparable to an SBA loan, plus the interest is tax deductible if you itemize. Home equity financing is an alternative to a personally guaranteed bank loan. The downside is that it puts your home at risk. In addition, it can put any cosigner, i.e. spouse, at risk too. If the business fails, you will still be obligated to fully repay any home equity financing. There are a number of equity sources for your company. The first is using personal savings. It is always an option if you have it. A second is a second mortgage on or home refinancing. Using home financing was more common before the financial crisis, but still an option if you have equity in your home. Of course, you're putting your home at risk, but the interest rate is low, making it worthy of consideration. Third, using an IRA, pension, or 401k to fund your company. You are putting your retirement savings at risk, but it may be the only place you have savings to do so. If you decide to do it, you can avoid the 10% penalty if you make an IRS qualified investment in your business. There are a number of internet sources that can guide you. Type in self-directed IRA or self-directed 401k into Google. Business partners or co-owners are an option for funding in some situations, but be cautious. Like marriages, partnerships can struggle due to conflict between the partners, and make sure your partnership is well documented by a lawyer with a buy-sell agreement. Outside investors, i.e. friends, family, angels, and venture capitalists, are also an option. Friends and family may be your best option in many cases. Just make sure you have a lawyer help you draw up the documents. Angels, that is wealthy individuals who invest in startups, or venture capital companies typically invest in high growth, high margin businesses, i.e. think high-tech companies. They will normally demand complicated funding agreements that can be very controlling and restrictive. Two types of crowdfunding. Rewards-based is the first one, and in that case you use a website like Indiegogo or Kickstarter and give a reward to the contributor, usually your product or service when it is already at a discount to your manufacturer's suggested retail price. Second, equity crowdfunding. You use an authorized federal or state website portal and actually sell shares in your company to investors. Each rewards-based website has a slightly different set of rules, so find the one that makes the most sense for you. For instance, if you don't reach your goal, Indiegogo deducts a portion of the amount you raise as a penalty. You get the rest. But Kickstarter will end your campaign and send all the money raised back to the contributors, and you get nothing. Fees are considerable and all in range between 5 to 10% of the total amount you raise, so the cost of doing a rewards-based effort is not cheap. The key to rewards-based campaign is a reward back to the contributor, usually your product or service, at a discount to your contributor. With equity crowdfunding, you have a choice of using state rules. MinVest are only for Minnesota companies and are more favorable for companies raising money than federal rules. The maximum fundraising limit is $2 million, and the maximum from each investor is $10,000. But you must use a Minnesota authorized website portal to do your fundraising and can only raise money from Minnesota investors. Federal rules allow you to raise money anywhere in the U.S., but you must use a federally authorized website portal. The maximum fundraising limit is $1 million, and the maximum from each investor is $2,000. Both the state and feds require investors to get company financials, a description of the business, list of officers, directors, and a list of certain related party transactions. The effective date of the federal rules is May 16, 2016. State rules are still being worked on by Minnesota Commerce Department, who have not set a final date for them. These are just a few of the websites addressing this topic on the web. There are actually 3 levels of funding at the federal level. We covered only 2 of the 3. The third is for large dollars and qualified investors. There are some specialized portals dedicated to films, books, education, nonprofits, and real estate. Do your homework and perhaps solicit the help of a qualified attorney in any area of this new funding tactic. Also, we believe the MinVest rules for Minnesota should be finalized sometime during the summer of 2016 and signed into law by Governor Dayton as well. You may believe that there is money available for your company because it is in other people's interests to help you or your business. Sadly, this is usually not the case. Grants are generally more available for nonprofit organizations. The grant source usually expects something in return, usually research or a specific service performed in exchange for the grant. So grants are available from most governmental bodies, from foundations, corporations, and even individuals. But the question is, what do they want from you? Most small for-profit companies find they just don't meet the grant criteria. But if you think your company might be eligible, research it. You can go to the SBA's website at sba.gov or to grants.gov, which specializes in grants from the federal government, to find out. Companies often need short-term debt. That is debt that is on their books for less than 1 year to finance themselves. This allows a company leeway if they need to finance receivables, inventory, or just run low on cash, possibly due to seasonal drops in sales, etc., at any point in time. There are a number of short-term debt options. They include a bank line of credit, which allows a company to borrow or pay down the debt as often as they like up to the limit of the line of credit. Obviously, this is a product you will get from a bank. A second option is trade credit from suppliers, which normally allows you 30 days to pay your suppliers. The good news is that it is almost always free if you pay within the 30-day period. A third option is personal credit cards. These are often used at the beginning of a startup to get the company going. The downside is that they may use up credit you need personally. So it makes sense to get a credit card for the business as soon as you can. The drawback is with credit cards, charge high interest rates, 18% plus, if you don't make a full payment in the required time, which is usually 30 days. Business credit cards are another option. Many companies use them rather than personal credit cards to make it easier to separate personal and business credit transactions. They have the same high interest rates and often low credit limits as personal credit cards, but they are often relatively easy to get. One drawback is that they almost always have to be personally guaranteed by the business owner. One helpful source for comparison is creditcards.com/business. A fifth option is accounts receivable factoring or invoice financing. They often involve selling off your receivables to a factor who is a financing source or receiving financing on invoices you create for clients. Both of these options are expensive and involve a fair amount of paperwork. They are not options for every small business, but may allow a capital-strapped or rapidly growing entity to get financing that can't be obtained from a bank. The last source are peer-to-peer lenders. These are websites that specialize in matching borrowers with lenders through their websites. The two biggest peer-to-peer lenders are Lending Club and Prosper.com. One thing you need to understand is that startups are risky and often hard for creditors to assess due to a lack of a track record to look at. Franchises and existing businesses are perceived as less risky. If you have management experience and/or industry experience, it is very important to emphasize it in your business plan or resume. This can help reduce the risk perception significantly and help you get financing. Creditors often use your personal credit history and credit score to help decide whether to grant your business credit. If you have a credit score over 700, you will have an easier time. If your credit score is lower, it will be more difficult. You can take steps to improve your credit profile and your credit score, which we will discuss in the next slide. Before you launch your startup, you need to get your personal credit reports and scores from all of the bureaus. Get them from annualcreditreport.com, which is truly free if you get your report just once a year and won't sell you anything except your credit scores. There may be some instances when you will need to pay for the report, so we recommend you check with Consumer Financial Protection Bureau ahead of time just to make sure there is no charge. Once you get your credit reports, look at them. There will be mistakes in them that you can fix to improve both your reports and your scores. But it takes a while, so give yourself enough time before you apply for credit. Also, visit myfico.com. This is the organization that developed the credit score and supplies it to many of the largest financial institutions in the country. They have lots of tips on how to improve your credit score. Also, apply for a Dun & Bradstreet number for your business at dnb.com. This organization is the largest business credit reporting agency. Once you have a number, you can begin to build a business credit history. This will help your business get credit from vendors, banks, and other credit sources as it grows. You need to anticipate future credit reports. What this means is that anytime you anticipate having to go out and get more credit, you should repeat the process of checking your personal and business credit reports and fixing any problems to maximize your chances of getting the financing you seek. You need to find a lender that lends to small business and to your industry. The best way is to ask some bankers open-ended questions. They can suggest the best place for you to apply. Many times we suggest that you start by going to the bank or credit union you are currently doing business with. Another way is to ask friends or family who are in business who they are using and how satisfied they are with that lender. You need to get your records in order. This means getting 3 years historical financial statements if you are buying a business. You will also need 3 years tax returns both for yourself and for the business if it is existing. In addition, you should have 2 to 3 years financial projections, which should be part of your business plan. Next, you have to have a business plan. Since the financial crisis, banks are required to have this in their file. Other lending sources will request it. So do a good one and have it reviewed by someone familiar with business plans and your industry if possible. Prior to preparing your business plan, view SCORE's webinar on business plan preparation. Once you have all of this done, submit it to the appropriate lender and wait for your credit request to be approved. Good luck. Here are some additional sources of information for your use. Your success is our goal. These 6 chapters in Minnesota would welcome the chance to work with you. Each community and market is different, so utilize this free resource. Our motto is SCORE, for the life of your business. We would like to continue to work with you throughout the life of your business. We are confident that we have the resources to help you do that. We have tried to anticipate the questions you might have as this presentation was made, but you may think of issues later. If so, and you have a general question, find your local Minnesota SCORE chapter and ask one of their counselors as your local support. Our SCORE counselors may not be conversant with industry or use of the internet, but they can help you refine a question, or they may know of local resources that could help you. On a national level, use the SCORE Find a Chapter tab to find your local chapter in some other state and set up a relationship there. You go to score.org for that. Finally, we have a special email address dedicated to your needs. We will attempt to answer your questions or refer you to a resource which other viewers may have suggested. We will answer only via email or Skype. This slide presents our standard disclaimers. All content is strictly for training and comparison purposes to help the viewer understand how to use the internet and technology to advance their business goals. SCORE does not endorse any vendors, and those discussed in this presentation are for examples only. Screenshots used in the presentation are for illustration only. Other service providers' screen will appear slightly different. Finally, we want to thank those who made this webinar possible. Mark Ratner has years of accounting and counseling experience. Thank you for sharing your knowledge. Veritas Marketing, who provides us technical advice so we maintain consistency and quality. And Spedco, whose funding makes these educational opportunities a reality. Goodbye and good luck as you move forward.